Good afternoon, everyone. I reset
Yeah.
You're still around. Alright. Okay. Am I loud? Am I audible now? Alright. So welcome everyone to a very first edition of Sunshine Strategy Structure Training rather. I'm so sorry. And this is our very first free physical class for this course. And you're welcome to Value Flow Trading. Value Flow Trading is a tech-driven digital education and financial research firm that started operation in 2022. I remember I was here for the very first physical training that held here, ATM cash flow to be precise. Ever since, VFT has grown to become a formidable brand in the industry, boasting a well-trained and equipped team of traders and marketers. Our mission is to create a sustainable, transparent, and peaceful platform for traders and investors to attain their financial goals. Our vision is to become the one-stop shop for everything financial markets trading. This is a picture of our seasoned trainers that usually take the trainings, be it ATM cash flow, FX bootcamp, this training that we're here for. Please, I'd like us to introduce ourselves, your name, if you're a beginner trader or an intermediate trader, and what you'd like us to call you during the course of this training. Again, as you're here, she's starting from you.
Alright, my name is Gerald. I'm a novice, I'm a beginner.
Even after the morning session, you're still a novice.
No, one thing for you is that you have to, it's a step by step. So I can't just call myself a pro just because of one session.
But can't you boast of being an intermediate trader after the first session?
If I post, people will ask me, okay, let me see your account ability that you're going to use and boost. So, well, yeah, I'm here to learn, I'm here to, grab this opportunity. Yeah, I'm here. And I would like to be called Jerome.
Alright, nice to meet you again, Jerome. Next person, please.
I'm Samuel.
Alright, if you'd like to call what during the course of the show.
My name is Sam.
Okay, nice to meet you, Sammy. Next person, please. Nice to meet you. Nice to meet you, sir. Yes, sir. Are you a beginner trader, an intermediate trader, a professional trader, or a profitable trader? Nice to meet you. Is this humility or? Alright, nice to meet you. And to our online community, it is nice to have you here. I hope you have a nice time during the course of this training. Sit tight, grab a drink, and take this ride with us. Thank you for coming.
All right. Good afternoon. For those of you who see my face in the morning, good afternoon. For those of you that this is the first time you are seeing me, good afternoon once again. Well done. My name is Lekon Shiemi. I will be taking us on something special this afternoon rather. So, like we said, this is just a training to help every one of us, start our trading journey and to be more profitable. So, I'll be taking us through this morning. We'll be looking at this morning. We are going to be looking at the sunshine scalping, why and how we trade. So this afternoon we'll be looking at what asset to trade and why we trade. For those who are novice, this is very, very simple. I know you've been hearing everywhere about, forex this, forex that, forex this, forex that. You even hear, hey, forex swallow my money, as if no, it's a shark and it came to your bank account to swallow your money. But you actually took your money to the mouth of the shark and it swallowed it. So today we are going to be looking at what exactly are we trading, because you hear many people say, yes, I trade. What do you trade? Do you trade water? Do you trade beans? Do you trade kerosene? Or you trade petrol, so that we can make you our friend now that subsidy is gone? I want to make friends who trade petrol. Amen. All right, so now we'll be starting from what exactly do we trade. In this industry, the first thing that people said to trade is forex. And what does it mean? It's simply a combination of two words, which is foreign exchange. Foreign exchange. When you hear the word forex, you hear foreign exchange. Also, we trade stocks. We also trade bonds. We also trade commodities, cryptocurrencies, and synthetic. What does that mean? Stocks, we mean they are bank stocks, company stocks. Also bond, like treasury bills. That's what we do for that. When it also comes to commodities, yes, there is actually chart for sugar. There is chart for cocoa. There is chart. Yes, there is. Very, very. I can show you.
It's good. Part of commodities.
Commodities. Yes, it's also part of the commodities, but it's more of a precious metal. Get it now. So when you see here commodities like that, you hear sugar, you hear cocoa, you hear wheat, yes, oil, you get it now. So they are part of those levels. Also cryptocurrencies. I know most of us had cryptocurrencies before. And when you hear cryptocurrency, what was came to your head?
Bitcoin.
Thank you! King of all. I'm not the one who say that, but it's assumed to be the king of all, Bitcoin. So after Bitcoin, what other coin comes to your head like that too?
Dogecoin.
Be mentioning any coin. What's your name, sir? Samuel. Maybe next tomorrow we are still going to have some coin. We have something like that too. So all manner of coin, you get it under cryptocurrencies. And also we have synthetic like this 75, this 100, boom and crash. So those ones are other platforms to trade that on, and we have a course for that. If you want to enroll for that, you can see me after the training, get to do that. But this is forex. The training we are giving you today is majorly forex, where you are going to get the real thing that will make yours. Yeah. The synthetic training is not free, sir. It's just 75,000 naira. Simple. So we are having it this month by 21st of this month. So if you want to enroll, you can easily enroll for that too. But today, based on this, we are giving for free is courtesy from Value Flow Trading, but sponsored by our dear broker, Equity Broker. So that's why we are teaching you forex, how you can easily cash out on forex. That's very, very simple. So that's why the email we sent to you, we ask you to download the trading platform, which is Equity. I believe we all get the email, right? You got the email too, right? Okay, you have challenge downloading the platform. Okay. You mean the MT4 of Equity, right? Yeah, what you are going to do for that, as we are going on in this class, you can type to your browser, just type Equity MT4 download. So when you enter equity, let me show us here. Let me quickly show us. I think we should quickly do that as we proceed so that other people can also benefit from that. Just come to your browser, equity. When you click equity broker, just log in under the platform rather. You see under platform, you see MT4, click on MT4. You are going to download that. Now under the MT4, look at this place. Under the MT4, download MT4 for Windows, click that, and that's it. You are done. You get the gist now? Yeah, that's the best way you can do it. Just go to your browser. Yes, equity broker, you are there. Do it on your system. You are downloading it on your system, right? Yes, download it on your system. Just use the browser on your system. You get that done on your system. You get it done on your system. Just download it on your system. It will be very, very much better there. So, way forward, what is forex trading? Forex trading refers to buying and selling of currencies on the foreign exchange market. There is actually a market where you buy and sell currency. Like you can go to a bookie and go and buy a dollar at the rate of 755 naira. $1, you pay 755 naira. So that is, when you do that, you've also involved in forex. What you just did is, you just transact USD NGN. You got the gist now? So USD NGN is just 755 to 1. Meaning $1 to 755 naira. You get the points now. So that's how that works. So that it is the largest financial market globally with an average daily turnover of trillions of dollars. Yes, trillions of dollars. Just fix a figure there, maybe $5 trillion. Punch your calculator, 755 times $5 trillion. And just make sure that calculator did not blow, because it's just going to show error. So you get that now. But it is possible for you and I to be part of this particular market. We can easily trade it. And how do we do that? With the help of our exchanger, with the help of our broker. You can easily do that. When you enroll with equity broker, you register there, they give you leverage, and you can easily, with just $100, you can easily be trading. You are part of the financial market. So you do it with leverage, you get your profit, you get out of the market, do it that way till you build enough capital to trade high volumes. You get the point now. So that's how that works. Now, who are the key participants in this forex market? The key participants in the forex market is not just me, it's not just you, it's not just him, it's not just any one of us in this hall now, but there are major people also in this. Every one of us here, as a trader, we all belong to a category of people in the financial market. And I'll show us the category we belong to. Now, who are those participants in this forex market? They include banks. Yes, those banks include the one in your head now. What banks come to your mind when I say they include banks? Zenith Bank. Yes, you are very correct. Zenith Bank also trade that. Including those banks in your mind, they are also part of the financial market traders. They also trade too. They are also participants of the financial market. Corporations, like companies too. Yes, they are also part of the market. Retail traders, that is that category we will fall into. Because do you have $10 million that you want to go and trade somewhere now? No, neither do I have. You get the point now? Even $10,000, bro, you are going to think it twice. Do you have it now that you want to go and trade it? No. You get the point now. But we all belong to a particular WhatsApp group called retail traders. So with our $100, we also participate in what a bank like Zenith Bank will do, in what a company like Dangote will do. You get the gist now. So, but how are we able to do this? Because we are actually leveraging on some people. You get the point now. It's like we should have giants fill the whole of this room. How will you look beside a giant? You just, maybe your head won't even reach his knee. But there are also some giants in the market that you and I can stand upon their shoulder. And those are our brokers. You get it now? So they give us the leverage, and you too, you enter the market. You press buy, it's going to show up. You press sell, it will show up. Is it that you have enough capital to do that? No. But why? Because you are leveraging on a broker. That's why. And also central banks. Imagine you and I, we are in the same market with CBN. That is, you can easily tell yourself, Mr. Godwin Emefiele, me and you, we are in the same market. Say, what market? It's not Kaswa Samaru, not Kaswa Sabu. We are in the same market together. The global market, the forex global market. How? You buy GBUSD, I bought it too. You make profit, I also made profit. But don't mention your profit, just hold your lips. And you move on. You get it now. So banks act as intermediaries, facilitating transaction and providing liquidity. What does liquidity mean? Liquidity means enough capital. Like now, I can tell you, oh, I'm not that liquid, meaning I'm not carrying much cash. You get it now. So that's what the term means there. So corporation engage in forex trading to hedge against currency risk related to business operations. What does that mean? Meaning other corporations too, import and exports. Those who import their raw material to produce our local goods, they also include themselves. They are also part of this market. Now, retail traders like individual investor, like you and I, we participate through online brokers. So that's why you and I, the way we can participate in this market is when we register with equity broker. Get the points now. So when we register with them and we load our account, we also participate in this market. And that's what we actually put this training together to show you and I how we can be profitable in this market using the strategy we want to hand over to you. You get it now? So that's what we are here to do today. Now, what are the major currency pairs? There are major currency pairs that are being traded on this platform. You don't just come and maybe you see, oh, USD, CNH or CNY. Oh, I just feel like trading this one. What is it? You don't even know what the CNY mean. All you know is there's USD in front. I will trade it. You enter with your $100. It waves you goodbye. You wave it back to the village. But there are some particular pairs that are very, very easy to trade. People trade it a lot. There is more liquidity in it. Pairs like Euro USD, pairs like GBP USD. You get the point now. Pairs like AUD USD, NZ USD. You get the point now. USD JPY. Those pairs that are not, when you open them, you just open their mouth like this and swallow you up. Now this is just an advice on a lighter mode. As a beginner and as a novice to this market, if you load your account with $100, I will advise be trading these, very common pairs, Euro USD, GBP USD, USD JPY, and nice like that. Don't go and start your trading journey trading SAU EUR, gold euro, or SAU USD. Don't start your career that way. Start your career on a lighter mode. Are we together now? Bros, are you with me? All right, you are welcome. So each currency pair consists of a base currency and a quote currency. What do we mean by that? This is what we mean by that now. Look at base and quote. You see it now? So like Euro USD, the base in the front and you have your code behind. You get the point now. So that's how we have it now. Say the exchange rate indicates the amount of quote currency needed to buy 1 unit of the base currency. Meaning that, for example, now USD NGN, how much N need to buy USD? 1 USD, 755. So that's exactly what this means. Meaning I need 755 naira to buy $1. And if I want to sell $1, I'm getting $755 if I want to sell just $1. And 755 naira for me to get $1. So that is that. Now, basic forex terminologies. You hear things like pips. That is the smallest unit of measurement in forex, pips. Meaning, if I'm entering, let me show us something briefly. So sorry about that. Yes, that's what I want to show us now. Now look at this now. Oh, our trade we took that time is still running during the morning session. We took a trade during the first session and it's still running. That's how the strategy works. You see now, you'll have been in profit for those who were in the morning session that time. They've gone now. All right. So what do I mean by pips? The meaning of pips is the number. For example, now look at this trade now. I entered this trade at 1.24636. Now I put my stop loss at 1.24740. The difference between these 636 and 740 is the number of pips. So if you subtract 740 and 636 from 740, what will that give you? That will give you something 104. You get it now? 740 minus 636, you are going to get 104, isn't it? So that 104 is the number of pips you are going to have here. So here you have something 10 pips. So the 10 pips is simply the difference between these last 2 digits. This last 3 digits, 74 and 63. When you subtract it. So I'm just risking just pips, 10 pips in this market here. You get it now? You can see the pips like that 104 the root. That 104 under pips. So the first 2 digits is the number of pips there, which is 10.4 pips. You get the gist now? So that is how that works. Now back to our work here. Yeah. All right. What? Yes. I don't get your question. Yes, when you subtract it. Yes, the digits are in the. Come and see this. Now this is it. This is the digits here. 636. You see it is the one by the side here. Where I entered, you see it by the side here. 636 and also 740. No problem. When you come deeply into the, when you go deeply into the training, you get it much better. You get it now. My colleague will definitely bring us up for that much better. He will definitely bring us much better on that. So let me quickly do this as we move forward. So lot, what is meant by lot is the size you want to buy or sell. The the size of the currency you want to buy or sell, you want to trade. So trend is simply the direction of the market. The market is not stagnant. Is either it's going up or it's coming down or it's moving in a sideways format. So when it's going up, we say that it's in an uptrend. When it's coming down, we say that it's in a downtrend. And when it's going sideways, we say that it's in a sideways trend. So if it's in an uptrend, we look forward to buy. When it's in a downtrend, we look forward to sell. So you don't buy against the trend. You don't execute against the trend. If the trend is going up, you buy. If it's coming down, you sell. Also, we have time frame. What does time frame mean? It simply means the view of the chart at so particular time. Meaning, in 5 minutes, I want to view the chart in 5 minutes. 5-minute time frame, 15-minute time frame, 30-minute time frame, 1 hour time frame, 4 hours time frame, daily time frame, weekly time frame, monthly time frame. I know someone will ask me, don't you have yearly time frame? Maybe you can add it too, because it is what it is. You get the point now. So we also have stop loss. Stop loss is simply the amount of money I'm willing to lose if this trade did not go my way. And also take profit, the amount of money I'm willing to leave the market with if the market did not if the market goes my way. So those are the basic terminologies in forex trading. Let me show you the stop loss and the take profit of this particular trade we took during the morning session. Now look at, this is the stop loss. The stop loss is above here. You see it? Now the stop loss is here, and you are going to see the amount of money there now. $104 is what I'm willing to risk on this particular trade. Where is my take profit? I think the take profit is far down. Okay, nice one. This is my take profit. Meaning all I want is $1,000 on this particular trade. But that sounds so big. Just $300 is enough for me, which I will still explain when I come back. So that is what stop loss, take profit, that is what it means. Those are the basic forex fundamental forex terminologies that you and I need to know. I believe this has been helpful for you. Now we'll be going proper into the main training, where my colleague will be teaching us the indicator we'll be using, what to be looking out for, how we are going to be using the indicators, when to enter the market, when to buy, when to sell, when not to do anything in the market, what to look out for in the market. And I believe you are going to enjoy it as we take it further. Thank you, cheers, and God bless you.
So before we proceed, who, if you know your name isn't here, ticked or filled, please indicate. Okay. Check your name. You have all these things. Nice. So, online community, welcome again. I'm seeing some faces that I've not seen before, and I'm seeing some of the faces that I have seen before. Either way, the aim of today's teaching is to ensure that whether as a beginner or an intermediate, you get started with something that works in the trading industry, something that works when you are trading forex, because that's the end goal of all trading, having a strategy that works. And the sunshine structure strategy can be used on any time frames, but specifically I would be focusing on the minute time frames, where you use it to scalp. And I'll show you the time frames you could use to trade long term as well. Anyway, before we proceed, I would like to get, again, to know the people that have traded before and those who are complete and utter beginners. So if you've traded before, just wave stylishly. Traded demo, okay, or live. Traded demo, okay. You traded demo? You've not traded before, okay. No, once your name is you can tick, if you find your name among the list to tick, you don't have to write it again. So you check the list first. Alright, so let's move on. If you were not in the morning session, which I presume most of us were not, looking at the chart, you are seeing some indicators on the chart. And we'll be explaining what they are. There are just 5 indicators we'll make use of in today's teaching. I hope the online community can see me. And then I will be going through what they are. And one more time, I will show how to install these indicators on your chart. I will go through it briefly because we've done videos on how to do that. And then I did that in the first session. And there's a video for that also. But for those of us that are just coming and do not know how to, I'll be showing you how to install these indicators on your chart. So this is simple. Assuming I have downloaded, registered with a broker. I've registered with a broker, equity broker, for example, because we use equity, we prefer it. And this is how the default chart comes as. This is the default chart. It's nice, I like looking at charts. This is how the default chart comes out. Then you want to set your template so that your chart begins to look like, so that your chart begins to look like this. So this is how we do it. There are sets of indicators that we install on our chart to ensure our chart looks like this. Now, if you have a laptop, which I presume you should, because this is an indicator-based course that requires you having a laptop. In your emails, you would have received an email with the indicator and the template. It was sent to you yesterday evening. However, if you do not have these indicators in your laptop or in your emails, we are still working on getting them to you. That's why we took your emails and whatnot. But I presume we that are seated here, we have it. Download those indicators to a folder or your download folder. It doesn't really matter. Download them to a folder on your laptop and know where they are. Inside, there are 3 indicators here, and there is 1 template. There are 3 indicators, and then there's 1 template. The hashtag forex semaphore, then we have the Fibonacci pivot, and then we have the TMA band, which is also the true moving average. If you don't have this, you can't trade the system I want to teach you today. So you should have it. Inside this template is sunshine scalping. Templates are preset chart settings on your chart. That when you set, you set, it's already set. You don't have to come and start, put indicators one by one, put TMA band, choose a color. You can't do that if you want to. But I'm showing we've found a way to simplify it for you because we trade with specific settings of indicators. So we have simplified that and put it in a template. That is what this is. This is just a preset chart setting. Now, this is my chart. I want to make my chart look like this. I want to make my chart look like this. That means I should have the indicators saved. The indicators are custom made. The indicators that come with your platform, your equity MT4 platform, is the moving average and the stochastic. These ones come with it. So, open it and you will find indicators. And then you open it. Now remember, I had a folder. I didn't copy it yet, so let me copy it now. Yes, this semaphore, TMA, Fibonacci pivot, Control C, or you can just right click and copy. Yes, let me go to File, Open Data folder. and then go to MQL4, then open indicators. L4. MQL4 indicators. Let me go back. File. Open data folder. This is what? Good. Open it. And then this is indicators. Open it. And then the indicators you copied, paste them. Now I've already pasted those ones. So it would not allow me, it would say replace or what. So I pasted them in the first session. And that's why if I replace it or skip it doesn't matter, I already have them. So this is how to paste them. And you will find the indicators on your chart. This is the semaphore. This is Fibonacci pivot. This is true moving average. Make sure they are showing here. And then just close it. Now we have templates already set. Now every MT4 by default comes with a template. There's a template here. It's set. If I pick one here now, it's a template. Now you see that there are different things on the chart. There's a moving average. There is a MACD. There is stochastic. These things are preset chart settings. Now we have set how the indicator should look like on your chart. We saved it as a template. Sunshine scalping. That template, I will copy it now. I will copy it. See it, sunshine scalping. You can right click, copy, or you use Ctrl+C. I come back to my chart, open data file, open data folder. Now I will not enter MQL4 because template is just outside here. So I will paste the template. I pasted it before. As you can see, sunshine scalping. Just paste it. It's there. Boom. So now, how do I now make my chart look like that? Right click, come to templates, right click anywhere, come to templates, sunshine scalping. Voila. You have it on your chart. These are the setups we use to trade. This is your Fibonacci pivot. The Fibonacci pivot, now I'm explaining what they are. We are using 5 indicators. 5 indicators. The first indicator I'll be explaining is the moving average. What does the moving average do for us? It tells us the trend. At any point in time, like my colleague must have explained, the market is either trending, ranging, or really choppy. So it will say ranging. The market is trending, uptrend, downtrend, or is moving sideways. So the moving average helps to tell us the trend. So how do I tell the trend? When price is below the moving average and the moving average is sloping downwards, like it is here, it's a downtrend. You can just eyeball it. Just look at it. The market is moving from here to here. The market moved what? Down. And look at where the moving averages are. They are sloping down. Where is price? Above or below the moving average? Below it. This tells you that the market is in the downtrend. When you have more than one moving averages on your chart, you expect the price to spread out. Look at this. The price was here. The moving average was in between. It doesn't matter how many moving averages are on your chart. If the market is in a range, the moving average will move in between. If the market is trending, depending on the direction of the trend, the moving average will be sloping. If it's a downtrend, it will slope downwards. Price will be below it. And then it will begin to expand if there are more than one, like you see here. If the market is going to buy, or if it's in a buy trend, look at this. This is a downtrend. This is a downtrend. Look at how the moving average is spread out. Look at where price is. Look at how this is also a moving average. And look at, I'm looking for a buy scenario. Look at this now, where the market broke above the moving averages and it started trending up. The moving averages were below. So for a buy trend, as many as the moving averages are, you want to see them below. You want to see price above it and moving averages below price. For a sell trend, you want to see price below the moving averages, and the moving averages are above price, sloping downwards. Who does not understand? Online community, if you have questions, you could ask so that we'll treat them as we move forward. The next indicator we'll be using on the chart is the true moving average, aka the TMA. The TMA is this black line. You could use any color you want. You just double click on it or right click when you hover your mouse, or when you right click you see something the indicator list. From here you go to your indicator, you can change the colors, but beware of the settings. Do not, I repeat, do not touch the settings, because this is how we found that it's proven on our chart. This is how we use it. So do not touch the settings. If you're uncomfortable with the color, or if you do not like white background and you want to use it in the night, change your backgrounds to. There is a video that explains how to maneuver your way through the MT4 platform on our YouTube channel. Join our YouTube channel, subscribe, watch the videos. Moving forward, the TMA band acts as an envelope. It envelopes price, and it shows also the direction of the trend. Look at how the TMA slopes up when price is moving up, slopes down when price is moving down, slopes up again when price is moving up, and then it ranges in the middle when price is ranging. When price started to trend upward, the TMA sloped upward and continued with price. Now, what else does the TMA do? The second, are you writing? Or you are screenshotting it in your head? Anyway, the second use of the TMA is to act as dynamic support and resistance. If you do not understand everything I'm saying, ask a question. However, if you do not pen down the things I'm saying, and then you think a 2-hour class will get you from the point of nothing to profitability, productivity, and consistency, you are grossly mistaken. The best I could do is to put you on a track to get to where you want to get to. The rest is entirely your job. You practice, you backtest, you go through it, you learn, and you work on it until you are good. And listen carefully. As powerful as what I'm teaching you is, do not trade it on a live account immediately. You must trade it on a demo and see consistent results before you move to a live account. If you are eager to go live, you'll be eager to come back. So as I was saying, it envelops price, and then it acts as dynamic support and resistance. What do I mean? Support acts like the floor, resistance acts like the ceiling. These are points in the chart where you expect price to change direction. So for support, I expect price to come to an area of support. Let me use this for example. This is called the horizontal support level. See how price reacted when it tapped it, broke higher, and it moved higher. Price tapped it and moved higher. Levels on my chart where I expect price to turn and sell. Those places are resistance. We've done a video on support and resistance. It's in our YouTube channel. So if you do not understand or you do not know completely, look at how price came here and started trending down. Now bear in mind that support and resistance can roll reverse. Price can be using this as resistance here. When it breaks higher, you can come back and use it as support. Roll reversal. So let me move forward with what I'm teaching. Let me just get these things out of the chart. Now, the next indicator we'll be using is called the sunshine, which is the semaphore, aka sunshine. The semaphore indicator is this yellow indicator you see. When you see the sunshine, that's when we get ready to trade. This, guys, this is what inspires our trade buyers, apart from the trend. So when we see the sunshine, we get ready to make money. When we see the sunshine, we get ready to trade. The sunshine price moves, if you observe price, it moves from sunshine to sunshine, sunshine to sunshine, sunshine to sunshine, sunshine to sunshine. Price moves from sunshine to sunshine, and when we see this, we are ready to trade. So it gives us an idea that, okay, I want to start buying now, I want to start selling now. It appears above price to inspire a sell. It appears below price to inspire a buy. Now, bear in mind that that's not all we need. I'm explaining the indicators. Trading is all about putting one or two ingredients together. It's like when you want to cook. You don't just come and say, okay, I'll just put only rice and put only salt in a separate pot. Put only tomato in a separate pot. You need to mix all of them, and then it depends also on the kind of food. I will not carry all the old indicators that are available in the market and place on the chart. I will carry the indicators that is needed for the kind of strategy I want to trade. Do we understand? Do we understand? Oh. If you don't understand, let's wave. Wave. Just use star and wave. Madam Jabs, you don't understand? Okay. Do you understand? Sunshine. We trade, yes. We trade from sunshine to sunshine. We buy when it appears below. We sell when it appears above. Yes. You get it? Okay. So that's how, but that's not all we need. I'll be explaining further. This is like I'm telling you why or what they do. Okay? All right.
This picture now.
Mm.
Is it exactly the same as
Yes.
when I'm seeing there are stars above and below.
That's the sunshine. This one.
And on my own,
It's not there.
sunshines are only above.
It's only above. Did you touch the setting? You didn't touch anything. Don't worry, we'll rectify it. Let me call later to help with that. Okay. CJ, you help him with it. All right. You will see it above and below. It should be there. Can we proceed? The fourth indicator we'll be using. I've explained. How many have I explained so far? The moving averages, the TMA, the sunshine. Yes. The fourth indicator we'll be using is also on the chart. This indicator is acting as support and resistance. It's called the Fibonacci pivot. Let me zoom out. It should be. Okay. The Fibonacci pivots are mostly, or is mostly used on intraday basis. They act as support and resistance on the minutes time frame. You can still see them on the 1 hour here, but they are more effective on the minutes time frame. So you see, if you observe, when price taps into it, it has the potential to change direction. So when we combine all these things, these are the things that would really, really help us take this trade. If you observe how price tapped into, yes, resistance. This is resistance 1, resistance 2, resistance 3. This is support 1, support 3, support 2, support 1 is around here. Look how price tapped resistance 3 and started going down. Then it now broke resistance 2, came back and tapped into it again. At that point when it was tapping, sunshine appeared. That's confluence. We'll explain better for how step by step how you take your trades. And the price drops further again. So these things act as support and resistance. In fact, most of the high probability trades or high probability setups comes from these things. If you are completely new, you do not know what currency pairs are, what a broker is, what time frames are, what candlesticks are, and you're looking at the chart and you're like, oh my God, do not panic. We've done a series of videos that explains all these concepts. Again, check our YouTube channel, because I can't start teaching that. Teaching that will have to take a lot of time. Forex is a really, really broad topic, or a subject on its own. So the topics inside, you have to cover them one after the other on your own. But this is to give you a place to start off from. The name of value flow trading. Value flow trading. So you go and study those things. When you learn those, you see that it becomes, the concept I'm saying makes it easy. Currency pairs, buy and sell, what is Forex, all those things are there. And if you have anyone that, okay, could you please do a video on time frames? Just leave it in the comment section. Our team will get it across and we'll do a video on that. Anything completely, if you want to know about currency pairs, if you want to understand how to place a trade even, we've done videos on that. How to start, how to get registered with a broker, there are videos on that. So moving forward, the last indicator we'll be using is the stochastic. The stochastic indicator, and this is the indicator you see below. I've explained everything you see on the charts here. Now I'm explaining what you see below. That's a stochastic indicator. It does two things. Mostly, in fact, one of the most important things it does is it identifies overbought and oversold regions on the chart. That's what it does. It identifies overbought, identifies oversold region. If you understand how to mix these things together, I tell you, this is like one of the steps you need. Of course, it won't make you a millionaire overnight, nothing will. But one of the biggest steps you need, the push you need to at least moving from where you are to get your journey started, knowing what you are doing, and even attain some level of consistency. If you understand this thing I'm teaching, you can start with it. So pay attention. The stochastic identifies overbought and oversold. If the market has been going, because we want to buy low and sell high. We don't want to be buying here. No, we don't. The market is too, even if it moves upward from here, the market has gone too far up. When I buy, I expect the market to go up. When I sell, I expect the market to go down. So I don't want to be selling where the market has a potential to turn. How do I tell? Using the stochastic indicators. So when the market goes overbought, especially now, if the market is in an uptrend, I want to be buying when stochastic is oversold or in the oversold region. I would repeat, if the market is on an uptrend, I want to be buying when the stochastic is in an oversold region. Which means that as this market is trending up, how do I know it's trending up? The TMA is sloping up, the moving averages are sloping up, and they are spreading apart, and prices are above it, like I explained. This is an uptrend. So I want to be buying when stochastic is here, oversold, around the oversold, and below the 50, this 50%. That's when I want to be interested in buying. I am not going to start buying when stochastic is here, or here, or here, or here. No. Because we buy in uptrends, we sell in downtrends, but we don't buy anywhere. We buy when stochastic is oversold in uptrends. We sell when stochastic is overbought in buy trends. Who does not understand so far? If what I'm saying sounds like Spanish, wait. Because the way you're looking at me, you're like, what the hell is this saying? It's quite confusing, huh? I get it. It's because you are new to it. Don't worry. Most of this concept they seem this way from the start. But with that consistent practice, now you have to take a lot of hard work. Go back, learn. But this is very simple. When I teach the strategy, you'll see that it's simple to trade. So, but I'm only explaining what they do. The strategy is just step by step. They are simple to trade. The only thing you will need to do for yourself is to learn what is a chart, what is a candlestick, what is Euro USD, what is GBP USD. So you learn those things. So you know how to relate with the chart, and there are videos already on that. So don't worry, you get it, but you have to practice. Precious? Are you understanding? Are you sure? Okay. I have to when I get there. Any question? Sir, you have a question? You are good. You understand everything I said. If I stand up and come down now, you can sit down and do all this. Let's move forward. Now, online community, if you have questions, you can ask. Now, I have showed you what they do. I've explained to you what they do and how we measure them, things they measure and how we use them. Now I'm going to be moving to how to actually use them on your chart. When they're on your chart, I'm moving to how to use them now. So I'll go to my PowerPoint. I prepared a slide already for this. It's not here. Excuse me. I think it should be this one. Yes. Give me a sec. I'm trying to open the. No, it's not this one. Should be this one. So how do I use all the information that he has been talking about to trade? This is it. You understand this, you understand the entries, this is how you enter the market. The fact that the market is always moving does not mean you should be in it all the time. Otherwise, you regret it. You enter the market at specific periods of time, and that's what people call a strategy. When you have a trading strategy, you have a technical strategy, or fundamental strategy, all those fancy words. They are just saying, I have a set of rules that I identify before I place a trade. That's just all it means. So, strategies have different win rates, different risk to reward ratio, but a strategy is just basically what I identify before I place a trade. Step 1. Excuse me. It says, determine if the market is trending or ranging using the moving averages on the 15 minutes. How? 2 things. The market is either trending or ranging. In a trending market, we need to identify whether it's buying or selling. Now let's use sample 1, sell. Pay attention, pay attention. If you've not been listening before, listen carefully. Sample 1, we want to sell. We want to enter a sell trade. You have a question? That we used to, and because we are scalping. That's why I'm teaching a scalping model. If we want to trade on a higher time frame, we hold our trades for longer, but we use higher time frame, and I will tell you what time frames we use for the higher time frame. But when you want to scalp, you don't want to go to the daily time frame and be looking for direction. Scalping is you are trading within the range of minutes to highest 2 to 4 hours. You want to sit down and watch the trade comes to completion or something like that. So that's why we are using the 15 minutes. I'm teaching the scalping part of it. So the 15 minutes, let me close this. So we have 2 tabs. This is the 15 minutes tab, and this is the 1 minute. We identify our trend. Sorry, I didn't change it. I was looking at it. Yes, I'm coming. 1 minute. Yes. I'll put it back. Don't worry. Okay. When I move there, you copy me. So this is the 15 minutes time frame. This is the 15 minutes time frame. Now, before I was telling the guys that were here before that I wanted to buy this market. When we started, the market was around here. Remember I was telling you, now that price has crossed the 4,000 moving average, I'm interested in a buy. And I was really hoping that the trade will set up before the first class left. And just the few of you that is left here is seeing it now. The price crossed the 4,000 moving average. It's one of the entry rules. And then we didn't jump into a buy because we want to see price come. We want to see sunshine appear below. Now sunshine appears below. Price crossed this, although the TMA did not really cross. But still, look at how price beautifully come to the stochastic. This is your buy. The sunshine, the moving average, for those that were in today's class, you would have bought. And if you are still in this trade, hoping that price will move higher further, because I told you, when the sunshine appears, get out. You would have taken from here to here. I really, really wish that I was here when I was teaching, that the market appeared, because when we were talking, the market was here. I would have showed you clearly, live, how we use this. You would have seen how we use it completely. This was the buy entry for this morning's class. So let's move back. The sunshine appears when it feels like. When it sees that, okay, I believe the market will turn down from here. That's when the sunshine will appear. If the sunshine does not appear here, it's here. Don't worry, when you came, we're not in the morning class. You understand when we move forward. You understand when we move forward. Now, this is how we identify the trend. This tells us whether to buy or sell. The 15 minutes time frame, if the market is sloping downwards and the moving averages are below it, the price is below the moving averages, sorry, that's a sell. You want to see price on the 15 minutes time frame below the moving averages, and the moving averages are sloping downwards, spreading apart. That's a sell trend. That should inspire your sell. That's what will tell you, okay, I'm selling now. Now, it says for sell setups on the 15 minutes time frame, you want to see the 50 MA below the 100 MA and the 100 MA below the 200 MA. What am I saying? In moving averages. In moving averages. Let me show you. And what? Sloping downwards and price sloping downwards. On the 1 minute, you want to see the 4,000 MA. If you want to copy this, you should copy it now because I want to go back to my chart. Now, what do I mean? Look at this. This is the 50 moving average, color blue. If you hover your mouse on it, it should point this. It tells you this is 50. If you move to the black, this black, this one. Moving average, what is this? It's the 100. Then if you move to this one, is what? 200. The 200. So when you want to identify that it's selling, you want to see the 50 below the 100 and the 100 below the 200, sloping downward, and price is below it. It's a downtrend. You understand? It's a downtrend. The thing with using this strategy, it helps filter all those, okay, is the market an uptrend? Is the market in a downtrend? Just look at it. It's there. If you understand it, just look at it. If the market is buying, you want to see price above the moving averages with the 50, the 100 is black, the 50 is blue, the 100 is black, the yellow is the 200. Just put your mouse on it, you could tell. And then you want to see them sloping upwards and price above it. This tells you the market is in an uptrend on the 15 minutes time frame. So when you now drop down to your 1 minute, what would you now look for to confirm or to tell you about? So some people that they do not like going to the 15 minutes, they just jump straight to the 1 minute. That's why this rule was set. On the 1 minute for a sell, you want to see price, and look how the market keeps buying. You want to see price below the 4,000 moving average. Yes, 4,000, such a big number. Yes, because on the 1 minute, it takes a lot to determine the trend. So you need a lot of moving. The moving average, it will measure the last 4,000 candles and tell you who is winning, who has been winning for the past 4,000 candles, buyers or sellers. And this morning when we came, we saw that the market was in a downtrend. But now, when we started talking, or when I started teaching, the market broke the 4,000 moving average on the 1 minute and said, I am no longer in a downtrend, I'm now in an uptrend. And that's why this was an entry for us to go long this morning. The trend is your friend until it ends. So which means that I stick to the trend before moving forward. So we kept saying this morning for the first session, I'm sure if they watch the video after now, they'll be like, oh, see our buy move. The way the price was moving, and the way the moving average started curving under it, and price is above, the blue is above the black is above, but the 200 are not really clear, so it's not really spreading apart. That's why we went to the 1 minute to confirm. And when price broke this 4,000 moving average on the 1 minute, I started going up. We said, okay, we're now buying. We're no longer selling. We're now buying. And for a scalping model, we would have bought, taking our profit, or would have taken partials. Like I was explaining this morning, there's a video on how to take partials. Taking partials is taking half or some of the position. So if you believe the market is still going up, because now it's in an uptrend, so we don't want to take our profit early and see the market move upward and leave us. We'll take some of the position. There's a video on how to take some or take partials. Then we will now move our stop loss to the entry. So if price like let it come back down, we've taken some money and now we are no longer in a risk-free trade. We are now in a risk-free trade. We are now break even. Who does not understand what I'm saying? Well, if you don't understand so far, again, we'll explain. So let me move forward. This is how we tell the trend for emphasis. The 15 minutes time frame. You want to see price below the moving averages, and then 50 below 100, 100 below 200, and they are sloping downwards. This is a beautiful downtrend. If you did not see this, but you saw this, at least you were here, you know that the market, the price is spreading apart. If you didn't see this and you saw this, you know that the market is still spreading apart and it's going down. If you didn't see this and you saw this before this big break to the upside, you know the market is spreading apart from here to the next day in the afternoon. You'd have been a seller, scalping. But you will not sell here. You will go to the 1 minute time frame and confirm if price is below the 4,000. And if price is below the 4,000, your job is to look for sell entries. Your job is to look for sell entries. So when the market opened yesterday, the market bought from here to here, and then when it broke down below the moving average again, my job is to start looking for sell entries based on what I will teach you. So combining the 15 minutes and the 1 minute gives you a sense of direction. It gives you a sense of direction. So see how when price is below the moving average, it sells. When price is around it and ranging, it's just ranging. When price is above it, it buys. Look at this buy. Look at this massive buy. Price even came close to it. It didn't break through it. It continued to buy. Your job is to be a buyer when the market is trending. How do I know it's trending? When on the 15 minutes time frame, the market, the price is below it for a sell, and the moving averages are sloping downwards and then you jump to the 1 minute time frame and see price below the 4,000 moving average. I'm interested in selling. For buys, the moving average is sloping upwards, price is above it, they are spread apart. And when I come to the 1 minute time frame, I notice that price is above the 4,000 moving average. Can I proceed? So we move to the next checklist. This is a strategy where you use to extract profits from the market. But you must understand the basics. If you do not know what a currency pair is or how to place a trade, all what I'm saying will be insignificant to you until you understand those things. Now look at the market. Look at the checklist. Look at the checklist now. We first of all identify where the market is going. Now we are looking at the checklist. Yes, a question. Okay.
So having this written down will help flow your screen.
Okay, copy it now.
No, first one.
Please write this down so that when I'm teaching you can be seeing it. Digital generation, Gen Z. They are just screen grabbing, they're just snapping. There was one I met outside. I was like, you didn't take notes. He said he screenshotted it in his brain. I said, okay. No, it's fine. If you prefer to take a picture, it's fine. There's no problem. It's it. Okay. Refresh. That guy is paying me out. I'm taking it on my account too. Alright, we need to move forward. Now we move on to the checklist. Now look at this. Everything, especially point 3, is really important. If point this and this are not met and this is met, you can even have a trade. You can have a trade. You could take a trade, but it will be quick. First one, when you've identified your trend, am I buying, am I selling? You now know that if you are in an uptrend, and I've told you how, you are buying. If you are in a downtrend, and I've told you how, you are selling. For scenario 1 now, that we are still looking for sales, you wait for the 1 minute, what does number 1 say? Wait for sunshine above, and then what's the number 2?
Wait for price to cross the 100 MA downwards.
What's number 3? Wait for the TMA band to cross the 100 moving average downwards. What's number 4? So we might not come back here. We'll be going through it step by step. I assume you've written it down where you've taken a picture. So you'll be reading it out to me. So now we want to sell. We are interested in selling. So this, we are not selling here. Now price has broken this. Price has broken the 4,000 moving average. We are interested in selling. Let me zoom in. Again. Because we want to sell when price is below the 4,000 moving average. Price is below the 4,000 moving average. What next? We wait for sunshine to appear. This is the 4,000 moving average. Sunshine appears where? Who can say sunshine? I see one here. Sunshine appears there. But that does not meet all our criteria. I'm looking for something that changed. Good. This now. I have a PowerPoint slide, but I want to show you on the chart so you understand that these things repeat before I show you on the PowerPoint. Now, sunshine appeared here. But the second criteria says wait for price to break the moving average sloping downwards. Price broke that. The moving average, the 100 moving average is the black one. Set a color you like, set a color that suits you. But price broke it. The third point says the TMA should also break it. Has the TMA broken it? What's the TMA? This one that envelopes price. It should break this 100 sloping downwards. Did he break it? Did he break it? If he broke it, say he broke it. He did not. Where did that happen? We'll now leave that one. Sunshine appears here. This was overnight, so you might not have caught it by that time. Sunshine appears where? Here. The market breaks the 100 moving average. That's the black one here. This is quite entangled. And then the TMA band broke it, sloping downwards. Can't see. If you can't see what I'm saying, say you can't see it. Okay, let me use this example. Because you can't, you're looking at me like you don't know what I'm saying. Everybody look at the screen. What is this? Okay. First rule, sunshine has appeared. Second rule says what? Where is price? This is price. This candlestick is price. The 100 MA is this one. The black one. Abi? Now price has broken it. Second rule fulfilled. What's the third rule? The TMA band. This is the TMA band. Look at where it crossed it. It crossed it here and here because it's up and down. Support and resistance. Here and here, sloping downwards. Third criteria fulfilled. What's the fourth one? Good. Now, Overbought region for stochastic is here. Oversold region is here. Overbought region, price crossed, sunshine appeared, price broke down, price broke the 100 moving average, the TMA band broke the 100 moving average, but the stochastic was not in overbought. In overbought region. This is where the stochastic came to overbought region. This is your sell. Stochastic came again here. Market, sunshine appeared, price broke it, another sell was on the way. You do not sell just because sunshine appeared. You do not sell because price broke the 100 moving average. You do not sell because the TMA band has broken the 100 moving average. You are interested in selling when the stochastic returns to overbought. And this template is still in place. That's when you sell. Now look at this example. Sunshine has appeared. The second rule says what? Price should break the 100 moving average. Did he break it here? See where he broke it. He broke it with force here. What's the third rule? The TMA should also break it sloping downwards. This is the TMA. This and this. Is this sloping down? This is where he broke it. You can change the colors to what suits you. This is where he broke it sloping downward. Then, what's the final rule? Stochastic. This is your stochastic. Should I have entered here? Let me do this. No, stochastic is not overbought. Should I have entered here? But it's going down. That's not the rule. When stochastic came overbought region around this side, that's when you are interested in buying. That's why there is a 50% level. It acts as like the overbought, oversold. At the middle is equilibrium. Equilibrium in the sense that it's equal, it's ranging. You want it to go above. You want it to be above the 50. In fact, close to this level is high probability. So I would have taken my trades where? Here. If I wanted it to come higher, I would have waited. Okay, no, this is not even higher. But my trade would have been here. And I've sold until sunshine appeared and I've exited my trade. Note, the sunshine repents. Sunshine can appear here and come here. It will move here. As price move, it will move. That's why we are adding these layers of confluence. This morning, when we were teaching, when I was teaching, before price, this appears almost everywhere in price. Before price broke down. Okay, now look at this. Sunshine appeared here. Price is below the 4,000. But does it mean I will sell? No. Why? Because second rule says price should break the 100 moving average. Did price break it? No. This was where price came to tap it and even continue moving on. So you do not enter the trade when the sunshine appears. It is all these ingredients that support your entry. Do we understand? Good. So moving forward, this is how, see how price came, tapped into the 4,000 moving average. Sunshine appeared. Do I sell? No. What happens? Price breaks the 100 moving average here. TMA starts sloping down. I waited for price to come above this place. This is my entry. From sunshine to sunshine. I'm in the trade. I don't know if you understand, but this is not high probability setup because the market later ended up in a range. So like this morning, we're interested in selling. We're interested in selling before price broke this high and started going up. But when price broke it, we changed our buyers from a sell to a buy. And always know this, if the market is not in an uptrend, you are not interested. So moving down to my chart. Your exits. Exits are places where you expect to get out of the trade. Stop loss, take profits. We've done a video on what is stop loss. Make sure to check it out. Stop loss is where price takes you out if you are wrong. And yes, you will be wrong a couple of times even. But the strategy has a higher percentage win rate. That is why over a series of time you will win. So you want to take 20, 50 consecutive trades to tell if this works or not. And it works. So over a series of trades is what you will determine. You have to develop that understanding that as a trader you must endure losses. So where do you set your stop loss? Above the sunshine. The sunshine that inspires your trade. The sunshine that told you to buy. On the 1 minute time frame. That's where you set your stop loss. Where is your take profit? When you see you are going, okay, now I'm selling. I now see an opposing sunshine saying, okay, the market could buy from here. You exit the trade. Especially if you are trading against the trend. However, if you are with the trend and you expect that the market would keep selling even after sunshine appears, because sunshine repaints, take partials. Partials is take some of the position, break even. That means from where your entry is and your stop loss, close the trade. Bring your stop loss to your entry and allow the trade to run. And when the trade gets to a Fibonacci pivot, exit the trade. That's what these stop loss exits are. So this is an example, but I want to use this preferably. Now look at this. This is sunshine appeared up. Price is not. Then we want price to break the 100 moving average. Price breaks the 100 moving average right there. Breaks it down. What else? The TMA band, rule number 3, to cross below the 100 moving average. The TMA band crosses it right here. Here for the first one, here for the second one. It crossed it here a while ago and then came back and crossed it completely here. You want to see it sloping down like it did here. It crossed it and now it's sloping down. What next? I now want to see the stochastic. Is that not the last rule? The stochastic over now sloping down. So would I have sold here? No. Would I have sold here? Maybe. Because at least it's above and it's an overbought. But the ideal, look at this. Overbought. This selling here is super ideal. Look how price goes back up. Stochastic goes back up. And when stochastic starts sloping down, enter your trade. This is the ideal sell setup. Ideal sell setup. And notice how it's looking similar to the one we showed on the chart earlier. Because the setup repaints. Look at this. Sunshine appears here. We could even use this, although this was when price broke down the moving average, so it wasn't really. But sunshine appears here. Now your TMA is already below your 100. Your TMA band is already below the 100, so that one is covered. Your price is already, where is spread price? Price is already below the moving average too. That one is covered. When do I now enter? When price returns here and shows another sunshine, because there's a sunshine here that could tell your trade no. So when price is already meeting some of your criteria, wait for sunshine again. Sunshine appears here and immediately price breaks the 100 moving average. Market goes down. Who does not understand the entry so far? Who does not understand? So you see how similar it is, because the rules are exact. If it's not what you used to trade. So if you take a trade and I come and I say, show me the sunshine. First of all, I ask you, did you buy or sell? Oh, I sold. Okay, where is the trend? You show me the 15 minutes, you show me the 1 minute. If the moving average is below the 4,000 on the 1 minute, I say, okay, you are with the trend. Where is the sunshine? You show me. Where did price break the moving average? You show me. Where did the TMA break the moving average? You show me. Where did price return and the stochastic was overbought? If you show me and you lose, that is a good trade. Because you will get losses, even in a good trade. It's better to have all these rules set and you lose than randomly making profit because it will not last. This, over a series of trades, over a period of time, will yield more results because it works. It works consistently. You will have losses. Beyond every reasonable doubt, you will. But over a period of time, your wins will be more than your losses, and they will be significant. Your setup must be this. It is so exact and simple. That's why I like our CEO, our boss, Pastor Jimmy. He finds a way to simplify even the hardest of the content. He simplifies it, breaks it down, because this does not, notice I'm not teaching you higher highs, higher lows, how to identify this. The indicators, they do that for you. Now, let me quickly move on. The next is for buy setups. Now, we've explained sell setups. It's the same, just opposite. For buy setups, I want to see the moving averages slope. Okay, on the M15, we want to see the 50 moving average above the 100 moving average, and the 100 moving average above the 200 moving average, and the moving and the 200 and the two. Yes, and then 200 should be should be below all of them. 50, 100, 200. Price should now be above all of them, and they should be spread apart. On the 15-minute time frame. Now to confirm, when I drop down to the 1-minute time frame, I want to see the 4,000. Price above the 4,000. This inspires my buy. This tells me I'm in a buy trend. Like when price, see how this market keeps buying. Like when price started sloping. Who was in this morning session? You remember when I told you that I think we'll be expecting a buy? Yes, because of how the moving average were sloping and price was above it. I said to the class earlier, and I really wish that the setup completed before they went so that they would see it. The market is now forming now, they've gone. That's one thing I love about a strategy that works. It gives you patience. If I jumped into that trade, I would have lost. But now that I see what I'm looking for, I am confident to buy, because the market gives you patience. You know what you are looking for, you are taking the trades, you are moving with it. So the 15-minute moving average now, as price is sloping up, I see the way price is moving away from it. I want to see it spread apart. Then, like this, like the way price did here. Excuse me. Look at this. This is an uptrend. So if you were here, you are looking to buy. I want to be a buyer. When you now drop to the 1-minute time frame, when you see price above the moving average, like the exact scenario that is happening, that happened this morning and still happening now, I want to buy. I'm interested in being a buyer. Why will I now buy? The checklist. The checklist. What does the checklist say? The checklist says, wait for the 1-minute sunshine to appear below. Then it now says, wait for price to break the 100 moving average and move upwards. Then it now says, wait for the CMA band to break the 100 moving average and move upwards. Then it now says, wait for stochastic to be oversold and then buy. You see how exact it is? I'm teaching you something that if you stick to it, just like the way, so you need to practice so that you can learn to trust the system. The reason why in front of everybody seated, I was interested in buying, and I would have entered the trade if I was sitting on this desk, was because I've seen it happen. I've back tested it. I've studied it. Let me tell you the truth. And this is the truth. This 2 hours class will only give you the kick you need. You will be the one to still steer the car. The accelerator is you that will press it. But that kick is what this class is for. What you need is what I'm doing. I'm giving you what, if you follow, you would use this to make consistent profits. You will have losses, but you will make consistent profits over time. Because you will see the setup play again and again and again. That's why I was interested in buying. But by that time in the morning, there was no sunshine. Now, there is a sunshine. Now, price broke the 100 moving average. Now, the TMA also broke the 100 moving average. What now happened? First rule, sunshine. Second rule, price breaks the 100 moving average. Third rule, price, the TMA band breaks the 100 moving average. The 100 moving average is the black, this one. This one. See it here. So when the TMA broke it, and it came down again, and look at your stochastic, my guy. Guys, this is the perfect entry for the buy. This is your buy. I don't know if you are seeing what I'm showing you. What I'm saying happened, this is the minutes time frame. This happened few minutes ago. And then as price is here, the sunshine has appeared. The market is an uptrend. How do I know that? Price is above this. So sunshine appears, you want to take partials. You don't want to rush out of the trade. If you are scalping and okay, you want to go, take your money and go. Especially if you are impatient. Take your money and go. But if here, below the sunshine, bring it to my entry where I entered here. If price goes back to the stop loss, it gets me out with no loss. And I have taken money when I took partials. Either way, I make money. Do you understand? Taking partials is super powerful, especially if you are using this strategy and you are with the trend. If you are not with the higher time frame trend, take your money when the sunshine appears or when price hits a Fibonacci level. Do not take partials if you are counter trending. The trade will go against you. This is it. This is how it's simple to see, simple to identify. Now, what do we do from where we are? The only thing we can do is to still. Now, price is here. From where we are now, what do we do moving forward? I showed you how to enter, okay? So, if I want to keep trading, Jerry Green, how do I keep trading? This is how you do it. You move to the 15 minutes time frame. You observe again. The entry rules does not change. From where I am now. Oh, sorry. I'm supposed to tap this. From where I am now, the price is still a buy trend. Especially when I start seeing the moving averages spread apart. So now you are waiting. If the moving averages start spreading apart or price keeps going higher, you are waiting to be a buyer. You are still a buyer as of now. And then you now move to this time frame. Price is still above the 4,000. You are still a buyer. This gives you patience. Do not take too many trades in one day. You are still a buyer. Now, price, how do I now enter a buy? You now go through the rules again. You wait for sunshine. You wait for price to break the 100 moving average. You wait for the TMA to break the 100 moving average. And then you wait for price to come to this oversold level. And then you enter the buy. You are still a buyer. What you are waiting for is for this price to come down a little. Then start turning back up. Sunshine appears. Price breaks the 100 moving average. TMA breaks the 100 moving average. The 100 moving average. Stochastic oversold. You enter. That's it. That's what you're doing. That's all. Super simple. It's looking like it's complicated because you do not know. If you don't know what Euro USD is, go and watch our videos. Subscribe. You subscribe, right? Subscribe and like. Yeah. What the? You're the only one who noticed that. That's true. Very true. Let me quickly do that. It's supposed to be the same currency pair. I didn't even pay attention. That's really, really true. Let me do that. I think you started to signal me that my time is up. If you have a question, you could ask. If you have a question, you could ask. Sorry? This thing is. Give me a sec. I have a question you could ask. Let me switch it, please. You can still see the screen? Alright. Don't worry. See, they are almost the same thing, sir. Your USD and they are correlated. So, yeah, that's it. Ask a question. Ask your question.
The better shades.
Okay.
Okay. Like, alright. Sunshine should be like here.
Mm.
Cannot cross. It's crossing like here.
Mm.
Or it can
Yes.
it was going on, and then it traced a little bit. I seen this on the 15-minute time frame. As it came down here a little bit, could I have gone into the 1 minute time?
That place where it came down a little bit is where price came down a lot here. A little, because that's the 15 minutes time frame. Let's mark it so we can find it. So his question is, as price came here, let me zoom in. Sorry. Price came here a little bit. It could have entered, but the stochastic is not oversold here. That's why you use the 1 minute time frame. On the 1 minute time frame, look at your stochastic. It's here. But then everything is sloping against it. That's why you want to wait for this to appear here. This is a better entry than this. You understand? Yes, your stochastic, see how your stochastic is oversold here? You're correct. If you are taking this trade, but imagine if you had entered here, you would have suffered this drawdown, you would have been feeling bad. Oh, the trade is going against me. Oh, look at how price tapped here. Here, this was our entry. See how price just rallied away from it. Of course, you could still see, but then you want to take the high probability setups and use the 1 minute for your entries. You understand? Okay. Any other question?
Exits. The question is, how do you decide? How do you know where to put your ticket? So it's not the exit and where to put it.
All right, so we have an online question that says, please, we should explain the exits again. That's good. All right, let me go back to the PowerPoint. This is exit for a buy, and I'll briefly explain it. The opposite is for a sell. I'll also show the screen. Write this down. Now, stop loss, set your stop loss, set stop loss below the sunshine that triggers your buy. And then for the take profit, it says set the take profit at the Fibonacci pivot that is ahead. You are buying. There is a Fibonacci pivot acting as resistance above price. You can set take profit there, especially when you are with the trend, or if an opposing sunshine appears. Now let me explain this. The first one says stop loss, right? Now I am, where's the 1 minute? Now I said I buy here, or here, because the stochastic was here. I buy here. No, okay, price crossed it, MA crossed everything here. This was where it beautifully crossed. So I buy here instead. This was the ideal buy for me. I buy here. Where is my stop loss? My stop loss is below the sunshine. Here. Below the sunshine. That's my stop loss. In other words, me entered the buy here. But when you start selling, going down, exit me here. Where is my take profit? When I am buying, I want to take profit when a sunshine appears and say I will start selling. I would exit the trade. However, if I am in a strong uptrend and the 15 minutes moving averages are sloping upwards and spread apart, on the 1 minute price is far away, price just broke the 4,000 moving average and is heading upwards in a strong uptrend, I believe that price will go to a Fibonacci pivot that will act as resistance. Let's find one. A Fibonacci pivot that would act as resistance on the chart. Okay, this was support. See how price hits support and started going. You don't just use it for take profit, you can also use it for confluence. When price hits this support, sunshine appears, it's also added confluence that, okay, this support level we hold. So there's something like this ahead. It could be on the 15 minutes time frame. It could be on the 1 minute time frame. I would take partials. Always take partials. When a sunshine appears, partials means take some. I will take some. Break even. I'm now in a risk-free trade. Allow the remaining to run to the Fibonacci pivot. Let me zoom out. You see one. Okay, there was one here. Resistance. What's the next one? I can't really find it. There should be a resistance. Either way, it's still far above. It's still somewhere up. These ones are here. But I'll take partials. That means I'll take some when the sunshine appears on the time frame I'm trading. And look at this 15 minutes time frame too. Another sunshine has appeared. So it's telling me that even if we are in an uptrend, the market could sell a little before continuing. So I don't want to be in this trade. So the sunshine hints you on direction. So if I'm buying on the 1 minute, here, where price acted as, this is even our resistance that was turned support. Resistance that was turned support. Price is now going higher. There's a resistance ahead that price would hit. If price does not, if I can't find that, I will use visual ones. What do I mean? A place on my chart where I expect price to turn away from. It could be where? Here. Why there? Because when price came here, it turned. So if I still hold this trade, I'm expecting price to get there before I take all my positions out. But I will not be in a trade where sunshine appeared on the 1 minute and sunshine appeared here. It could sell a little. If I want to continue my buying, let my entry criteria be met again. So that's it for the exit. If I'm selling, if sunshine appears below, I'm careful. I take partials. If I'm with the trend, I take partials, break even. If I'm not with the trend, let's say I'm buying, but I stubbornly went to the 1 minute and I'm selling, I'll run away. Sunshine, opposing sunshine, and then when price goes to a Fibonacci pivot level, those are my exits. So the entries are clear, the exit is clear. If you have a question, please. All right, let me hear you. I enter a trade on 1 minute. Yes, I was emphasizing it. To just check the trend. Yes, and I can also use it for take profits too. Like I did here. When I was showing you that sunshine appeared here, sunshine appeared here. I want to be careful so that I exit. If sunshine appears here, I'm running out. That's it. So I use the 15 minutes to tell the trend and the 1 minute for entries. Understand? Okay. Any other question? Okay, he wants to see the.
You actually send everything as email.
Even the slides?
You get the slide and everything.
Okay.
As an email. Yes.
You get it.
As far as you registered with your email, everybody will get the slide. Yeah. We are sending it immediately by 3:30.
You get it.
Including the videos and
So my colleague will complete the class. This is the end of my session. You have a question? That's all. You have a question? Ask. Before I go.
Is there any possibility to take partial results?
You only take measure the price moves in your favor. Moves a little bit in your favor. But they will be teaching us to explain everything when it comes to the entry and the process. Cheers. Okay.
Thank you so much, Cherry. You can appreciate him more better than that. That's a very, very deep one. What? That's over 1 hour, man. That's amazing. That's amazing. So, I believe we've gotten strategies very, very well. Get it to it. You get the strategy. So 80%. Okay, you need the 20% more, right? I believe this one, what I'm about to take now, will be 20% of it. What of it, sir? 80% below. All right. Well, the slide and all the template, everything will still be sent to every one of us. We are going to get all these slides right from the introductory part to the last one I'm taking now. So all the slides will be available and we are going to get it all ready. So now I will be taking us on risk management now. I will be taking us on risk management. You see, as a trader, if you don't understand this, then your trading journey is just zero. A trader without risk management is like buying a very good, beautiful Mercedes Maybach without brake. Very fine, very, very beautiful. Shooting himself, or even you just sign a death warrant, like I'm ready to go. That's it. Having a very beautiful car without brake is just. So that's why we are taking risk management very, very important. As a trader, you have to understand risk management. It should be one of your main tools. And how do I mean? It's simply you knowing what you can afford to lose and what you actually want to get from the market. Like we all know, the market is not anybody's father's house. It's not my father's house. And that, so whatsoever we get from it is give us this day our daily bread. When you get that daily bread, don't look for monthly bread in a day. Yes, very, very important. Many people already got their daily bread for the day, yet you are still waiting. You want to get your monthly bread in one day. A yearly bread in a day. It doesn't work that way. What will you now be doing the rest of the year? Oh, so it doesn't work that way. At the end of the day, so you have to have a proper risk management when trading. And how does that work? First, you have to understand how you set your stop loss and also your take profit. Your stop loss and take profit. Now, it is highly advisable that you shouldn't risk more than 1 or 2% of your account on a trade. How do I mean? For example, if I'm having a $100 account, all I want to be risking on that account will be $2 on each trade. $2? Yes, on each trade. On the $100 account. I know it sounds very, very weird. It sounds very weird. And that's why most people will always blow their small accounts. And I'll tell you why. Okay, I'm going to make it look big to you now. Now, if you are trading a $10 account, losing $200 on a $10,000 account, how would you feel? Yes, $200. Oh, that look big, right? $200 look big. It's still the same strategy, $200.
So $100, you lose $100. Losing $2 on a $100 account. That's how many? Wait, let's get what you say.
Now, depending on your lot size, I know on your $100 lot size, you want to be doing like 0.10 lot on the $100 account. 10 lots. You want to do 10 lots on the $100 account. Bravo. That's the fastest route to your village. The way you come is the same way you go. Easy way. No hold up, no go slow. But on a $100 account, it's highly advisable. You shouldn't use more than 0.02 lots or even 0.1. It's taking it gradually, building the account, building. The same way you see that $200 is a very big money losing on a $10,000 account. That's the same way you should see losing $2 on a $100 account. Because the same way, that way you see, it's not just $2. That's how you also just lose, it's not just $20. And if you lose $20 5 times, the account is gone. So if I just lose $2 on a trade, okay, I'm wrong, no problem. If I'm using 0.01 lot, for me to lose $2 on 0.01 lot, then that's 20 pips stop loss. I know it sounds like that chicken change. Where will I now get the huge profit? You just be making it little by little. If you can grow a $100 account to $20 using that normal risk to reward system, then you have more confidence in yourself trading $10,000 account. And that's the mistake many people will do, because you'll be like, is it not $10,000? $200 is nothing. Before you know it, $1,000 is gone. So when you use proper risk management, it helps you to manage your risk very, very well. Now, what do I mean by risk to reward now? It's simply what you intend to do in respect to what you want to gain on that particular trade. For example, now, I'm risking, now it is highly advisable you do at least 1:2 or 1:3 on each trade. What do I mean by that? If I'm risking $2 on this particular trade, that means I should be targeting $6 as my profit. That is 1:3. Do we get it right now? So I'm risking $2, I'm targeting $6. I know that sounds very, very small. Man, that's too small. Why not risking $2 and get $20? Bravo. Nice one. Is it not possible? It's very possible. How long? I don't know. It's very, very possible. I'm risking $2 to get $20. How long? I don't know. Can I do it in a day? Why not? How often will that happen? Not every day. And I don't know. I don't know. So test it yourself. Then you see the outcome. So the best of it is, let's keep to 1:3 for start. As a beginner trader, keep to your 1:3. Meaning you are risking $2 to get $6. When you take that, your first trade, and like I always say, make sure you take at least or at most, it depends on your psychology, 3 trades in a day. Now, if I risk $2 for the first trade and I make $6, that's my first trade for the day. Now I've banked my $6. The second trade for the day, I risk $2 again and make $6. Is that not $12? Now the third trade for the day, I risk $2 and make $6 again. That is $18 in a day. Close that laptop and wait the market goodbye for that day. But I know that's just an advice into the air. You still try it again. And the first one that you are risking $2 and you lose it first time. The second one, no, this will be the 5th trade, right? The 5th trade, you risk your $2 and still lose it. Now, instead of you to just come out honorably with your $6, it's not even the $6, okay, yes, you still have your $6. Now it's down $2. Now, you now go the third time again, $2 and still lose it the third time. Now all you gave us, you've given it back. Meaning, what you get from the market that day, you already give it back. And like I said in the beginning, for you to buy or for you to sell, there's also someone waiting to buy from you that you don't know where to is. So when you click sell, someone is also, as you are making money from that sell, someone is also, buying when you are selling. So that's the way it works. So when we are talking about risk to reward, is for you to determine how much you intend to risk on each trade and how much you intend to get on each trade. So it can be very, very easy Now, it says, as a day trader, it is advisable to make your risk to reward ratio 1:3, which means on every 1% of your capital risk, you make a reward of 3% on it. Now, I know that $2 to make $6 doesn't sound well and doesn't sound proper, but let me give us this illustration. Imagine you've loaded your equity account with $10,000. Now you are risking $200 and you make a profit of $600. How does that sound? Fair enough? Great. Imagine just one day you made $600. Sounds big, right? Now the same way, that same day on your account too, your $100 account, you risk $2 to make $6. That's also the same thing. If you have, and also if you have a $100,000 account, or you are just risking, I know ahead, this will sound so big. You are risking $2,000 to make $6,000. How does that sound? Huge. I know your head is the exchange rate now, but that's how it is. You get it now. So we must make sure our risk to reward is very, very, manageable, in a sense that really will help us out. So let me show us how you do that on your equity broker platform. This is what you do there. Now, for example, you are buying here. Let's say I'm opening a trade here now, and I'm buying. Now, if you have to open a trade there, what you just come to do here is you enter the lot size. If you are using a $100 account, your lot size will be low. You get the points now. So now this is a $5,000 account. What lot size will I be using? I won't be using. That's the lot size I'll be using here. Now I'm buying. Now, how do I determine my stop loss? All I'll just do is, how much am I risking on what's the 2% of a $5,000 account? That's just $100. I'm not risking more than $100 here. You see it? Yes. Oh, sorry. That's a TP. Sorry, I just saw that now. Now look at. I'm not going to make more than this. Like, I'm only risking just $100. That's all I'm risking. To get what? Yeah, I'm listening. Yeah. Yeah. Now, look at this now. That's where this is where my stop loss is. This one, right? All right. Now, if that should be the case, then my entry rule, if I'm buying, my entry rule, I ought to wait for price for it to come down towards this side. You get the gist now. You get my gist now. And if it doesn't come to that level, okay, good and fine. All I'll just do is reduce my lot size and take this. Because the key word there is my capital preservation. You get it gist now. So when I put this as my stop loss, then my take profit will be somewhere around this place. 1:3. I'm doing that to get a $300.
Are you just doing it casually, or you're also considering levels that?
Now, reason why I'm taking this, I'm not taking this trade based on, we did not analyze the market. I'm coming to take you, what I'm taking you is just the risk to reward. What I'm risking to what I want to get. If you are to analyze the market before executing this now, I'm not going to buy at this level. Ma? If I'm to take this trade now in line with what is on the chart right now, I won't buy here. You got what I'm trying to say now? Exactly, that's what I'm explaining. I'm only explaining risk to reward. What am I risking to get what? So I'm only risking this $100 to get $300. That's my 1:3. Now, if the market now moves to 1:2, what will I now do? If I see $200 in profit, all I'll just do is shift my stop loss from negative, from a loss now, to break even where I entered. You know, it's not possible now because it has not moved in my direction. You get it now? But the moment I see 1:2, I break even. And what does break even mean? It simply means now the market has gone in my direction. I'm putting my loss on the particular spot I entered, or a little bit ahead of it. Meaning, if price comes back to this level, let it kick me out of the market instead of it to now go again. Imagine you're already seeing $200. You did not close, and you now later went to minus $98, and your stop loss is just $100. Even you hardly forgive yourself. So better when you do 1:2, is either you close half of your position in profit, you bank that, and then let the rest run. Even if you want to do 1:10, just close half and let the rest run, then you break even the rest. So that is what majorly your risk to reward will do for you. It will help you to know exactly where and when to come out of the market, and also what you can afford to lose or gain in the market. So that is it. So it is highly advisable for every one of us to learn risk management. It's very, very important. As a trader, that is one of your trading arsenals. If you don't get that, you will burn your hand so quick. And it's not only your hand that you burn, you even burn the account too. So please, risk management is very, very important. So this will be the end of today's training, and by God's grace, on Friday we'll be having advanced training for people. Like during the morning session, we do those to register, and what will be the ticket for that is just for you to load your, everybody, I believe we've all opened our equity broker account. All right. I'll go and look into that at the technical unit. So we'll see to that. If the registering has any issue, we'll see to that, and I will get back to us. So what you are going to do is, when you are able to register, just load your account with $100, and on Friday we'll be here to trade together. Every one of us will take live trade together. An equity broker will take live trade together, and also, yes, when you open account with equity, you go to your dashboard and you're going to see deposit, all the profiles there. Deposit. The video is part of what was sent to your email. Yes, it's part of what was sent to your email. Yes, everything is part of what was sent to your email earlier. So you are going to get that, and also we'll be teaching also on Friday advanced structure when you are trading. Just a more ice, how will I call it? A more icing to this particular cake eating today. We'll be adding more icing to that on Friday, and at the same time, we'll all take live trade here together with everyone on the floor. You trade live with the trading team on Friday. So that's what we do. On Friday, this will be our trading floor, not the other side. Yeah. We are going to take live trade together here. So just make sure you load your equity account so that we can take it together. You know, you can't take live trade on demo account. You'll just be looking at the money there, and there's nothing you can do with it. So on Friday, we'll have live trade together on Friday, and whatever you make as your profit, It's been real. Get to cash out. That's how it is. It is what it is. But make sure, well, we won't be here to see it. You are going to use your risk management. You will put stop loss on that trade. And yes, that's one of the main keys. So we'll see everything by Friday. We'll be expecting you. I would love to have you around on Friday to do that together. So you have the feeling of the floor and how we go. Thank you so much. God bless you. It's nice seeing everyone again this afternoon. God bless you. See you some other time on Friday. God bless you. Yeah, if there's any question you can easily ask. Yeah, the platform is also on the, yes, what you just do is when you go to equity website, you are going to see platform. Now when you click platform, click on MT4. When you click on MT4, you are going to see equity, download MT4 for Windows. Also, is there, the option is there. So you are going to get that on your Mac.
The setup for this, I would like to
It's on your Gmail. Exactly, yeah. How you are going to set everything up is on your Gmail. Just watch the video and just follow it step by step. You get everything done. Sir? Sure, no problem. And in case maybe there's any issue you couldn't do that, when you come on Friday, just make sure you come early on Friday. Yes, come early on Friday. And make sure you go to your account. Because, sir? Something around that. Get it. Is your money. You're not paying someone. You're not doing it to your personal account. And you trade it that day and make profit. You are not giving us anything. You are not collecting anything. You make your profit, you swallow it yourself. You can't give us because it's in your account. Yes, we gave you something. It doesn't now. That's our own. That's our own way of giving back to the community. We are saying thank you.
So it's guaranteed that the trade will go with profit.
It's not my father's house, so. Yes, that's why we are thank you. That's why I'm taking the risk management. So thank you. Exactly. So we'll be together. Yes, no problem. Even if you borrow money and you load 1,000, all you are risking on your trade is 1% or 2%. It depends on how greedy you are. And if you like, you want to risk 50% of your account on your own, waive you. Thank you. So, but risk management is truly the key when it comes to trading. If you don't understand risk management, go back to the village. So that's that. See us on Friday. Thank you so much. Everything you see, our participants, things you expect to do. But financial part, investment,
Alright, so everybody say right. Don't have lights, but it's alright.
you can still work. This one too.
Yeah.
And as much as even you are able to grow, you can always grow. Anytime you able to grow, you can just
Please don't do that.